Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Somasundaram, PRMT at India World Gold Council joining in. Welcome to the show, Mr. Somasundaram, and a pleasure to speak to you as always. My first question coming to you overall is the kind of commodity landscape that we've seen in the last couple of months. What is it that has actually been supporting this kind of a rally that we saw?
Well, one of the things is specific to gold I'm talking about is
Hmm.
the fact that uh, uh, the prices, the U.S. interest rates in particular, and the expectations of risk. These were the two very important factors. It drove up the price. As you know, it touched even 2000 early part towards the end of last year, and then it started softening. Uh, Today, I think it is hovering between 1750 and 1850. It is range bound for the last couple of weeks or months, and but there is always that undercurrent of pressure building up because of excess liquidity, the concern about the monetary policies in various countries. But
Hmm.
at the same time, currently there seems to be a big appetite for risk assets like equities, which is one thing which is keeping gold in this range bound price
Hmm.
performance. But the clear answer is, yeah, the loose monetary policies. I wouldn't say loose, the relaxed policies, and the U.S. interest rates. So these two are the factors which are making gold perform the way it is, and it is supposed to perform this way because it is, at the end of the day, known as the safe haven.
Hmm. Right. So overall, right now, what's the kind of trend that you've seen with regards to where allocation is concerned?
Well, we have seen a significant jump in ETFs last year. I mean, I'm talking about the calendar year. Um, uh, we saw inflows of up to 800 tons last year. In the current year, in the first half, of course, we did see an outflow, net outflow, although in quarter two, we saw an inflow. In quarter one, we saw a bigger outflow, which was made out by some inflows in quarter two. This is a June quarter. But overall, if you look at the ETFs, which kind of reflects what investors think about gold,
Hmm.
there has been a significant jump in allocation. I mean,
Okay.
2020 was one of the best years since 2008 when we saw the financial crisis. So clearly, when as things turn out to be what they were as in 2020, investors tend to move to gold
Okay.
as a safe haven asset. And we saw that absolutely performing. The second important thing is look at how central banks have behaved. ETFs is one specific thing. The other important factor to note is how
Hmm.
central banks have behaved. Central banks again have been consistent buyers of gold, right? And particularly so in this quarter. If you see, central bank buying has really gone up to levels that we have seen in 2018 and 19. So, and this is again without China and Russia, which are the two big players.
Hmm.
Now they are out of the market, but still you saw various central banks, including RBI, collectively, the first half has seen almost close to 200 tons.
Right. So with all of this, if you could just help me understand the last data that I was reading as well, wherein it's the record outflow number that we've seen overall with regards to gold ETFs in FY22 so far. What's the reason for the same?
Well, as you said, 2020, the gold price performance was excellent, and also the risk appetite was very low.
Hmm.
So therefore, investors generally flocked to gold, and ETF was the beneficiary of that. What happened in early 2021 was that economies opened up, and we also saw vaccination pick up, and the US yields again started going up. It touched the treasury yields touched nearly 1.75. So this combination of factors made investors, certainly some investors who have invested in ETF, to move away from ETFs and go into risk-based assets. Okay, so that was one of the reasons why we saw a big outflow in quarter 1. Quarter 2, again, we saw an inflow, but it was not as high as it was in the last year. It was hardly 10% of what we saw in 2020 quarter 2. But still there was an inflow, but that inflow was not enough to make up for the outflow of the first quarter.
Okay.
So the outflow in the first quarter, which happened this year, was essentially a factor of the gold price performance in the short run. So people tend to move when they see a range-bound price performance. They tend to move out to other assets. That was the reason.
Right. So with all of this, do you think the allocation that has gone up in terms of gold as an investment, as a safe haven, is there a possibility that that will sustain over time right now? Or do you think once, the pandemic is again receding now, the allocation towards gold as a safe haven is something which will start diminishing?
Well, as you have seen the recent paper which we have let out, inflationary expectations are coming back. All right. And gold has always performed well when inflationary expectations are high. And we all know that, every country has supported the economies in the last nearly 2 years. It's going to be 2 years now with surplus liquidity. And I don't think the economic performance is going to absorb all of this liquidity so easily. And while Fed is talking about taking it back, it is not going to be easy. What happened between 2008 and 2020 itself is a lesson about how difficult it is once you have followed loose policies for a while. So, given these situations, you will clearly see that gold as a safe haven will have a stronger position in the next couple of years. And you saw yesterday, one of the big investors, Mark Mobius, has also said that, look, you should allocate. Of course, he was talking more globally. 10% definitely should keep at least in gold, because he sees currencies will get devalued further. So this is, and it reflects sentiments across big investors as well. So in my view, I think therefore you will see gold's performance actually getting a little stronger amongst investors as a portfolio diversifier in the years to come.
But do you think there is a possibility that gold's weightage with regards to where the commodity indices are concerned, that could also increase going ahead from what it is now?
Well, it all depends on how the other factors play out. But yes, if you really look at what's happening around the globe, there is too much of uncertainty. It is very difficult to say which policy is going to work, and is the policy going to work across all countries? It's not simply about, if this policy has worked in the US or in Europe or in India or China. It's about many other countries as well. They are all part of the global system. So are they going to work? So given so much of uncertainty, I think gold's role will get enhanced. And therefore, my expectation is obviously very positive about gold playing a bigger role in the monetary system as we go along, as a portfolio diversifier, and even as a mainstream asset. Digital forms of buying and selling gold are increasing a lot, apart from ETFs and others. So you will see that this trend now gets accelerated. And gold, again, as a important monetary asset, will probably play a bigger role than it did between 2008 and 2019. The first crisis, actually in 2008, the big crisis, really brought gold back amongst investors. This crisis probably is going to catapult it into a much bigger position.
Right. And overall, how big a factor is the liquidity as an investment in terms of gold? Because clearly, gold as an investment asset, the liquidity vis-a-vis other commodities is way higher. So does that also play in as a factor to attract investments?
Yes, it does. And their ETFs have played a stellar role if you look at gold, because while there is still always a lot of scope to improve accessibility to gold and also fungibility, because it's still, it's you compare it with a dollar or any other currency, gold still has some issues. But overall, if you see, ETFs have played a very, very good role in increasing the liquidity of gold, clearly, for big investors. And what's happening around the markets, including in India, for instance, the gold spot exchange is coming up. We are talking about the International Bullion Exchange. And these developments also will certainly over time improve the liquidity of gold, improve fungibility of gold. So we are going to see the bullion market play a much bigger role in the monetary system as we go into the future.
Right. And overall, do you think allocation in terms of investments to gold is something which is pretty much under right now? And the ones who have not really done this, I mean, the quantum which is required have probably missed the opportunity.
Yes, we have always seen that. We have back tested many portfolios. We have proved in our case for gold in specific markets as well, including India, that when you have an allocation of gold, 10 to 15%, in various pension portfolios, those portfolios would have probably seen less volatility and greater risk-adjusted return. Okay,
Right.
and this has been proved with data of the past. So clearly, yes, you need to look at allocations. Institutions which haven't probably looked at gold as seriously as they should have, probably will return to look at now gold. And what will help this process is also, as I said, various developments happening across the globe in making gold more liquid, more accessible. And therein again, I would point out, although it is closer home, what is happening in India is also going to help us. The exchange part. It's not that exchange overnight will change things. What does it do? It is actually improving the bullion ecosystem. It's providing investors a very good platform to buy and sell gold with ease, with integrity. So these things in the next few years will matter a lot more and bring in a lot more investors into bullion.
Right. And if you could just help us understand, usually when a retail investor looks at gold, it's somewhere taken in a very similar format to industrial metals. But however, gold does behave differently from industrial metals, in terms, and most of the commodities in general. So how should one actually look at gold separately vis-a-vis other commodities?
Well, when it comes to gold, as you said, it is a quasi currency. Unlike other commodities, it's a quasi currency. It's not just about a price play. It is one of the it's the only commodity, in a sense, if you can call it a commodity, which even central banks still have as part of the reserves, right? So gold has a very unique place in that sense because of its legacy, centuries old legacy across. While it is still worn as a jewelry, it is still seen as an investment. And you also have closer home, I'm talking about, you can actually monetize gold in ways that you cannot do with other commodities so easily. You want a loan, you can actually take gold, collateralize it and take money. It's not so easy with any other commodity. So that's what I said, gold is a quasi currency in that sense. So therefore, and this position cannot be just removed, displaced. So you will therefore see that what is happening as developments now, with all the things happening around the globe, what is China doing? What's India doing? What's London doing with this? So given that, you will only see that this feature of gold as a currency, as a portfolio diversifier, is definitely going to be far stronger than other commodities. There's no doubt about it, because it will take a long time. You have a gold ETF. You still are looking at, is there a silver ETF in India? Is it possible to form it? But therefore, gold has this head start because it has been a currency in the past. So this is going to be an important thing to support gold. And so I don't know whether I can answer that. You're not going to be able to remove all these aspects and features of gold, or you're not going to be able to build all these with other commodities so easily.
Right. And overall, how are you seeing the consumer demand? Is the recovery strong? Because at least in terms of where the kind of Q1 outflows we saw, the demand recovery that we saw in the second quarter, in terms of gold ETF inflows, they were not really enough to offset the heavy Q1 outflow that we saw. So how's the sense that you're picking up, from this quarter onwards as well?
See, what is happening is gold has this is a very unique place where last year when the prices were shooting up, consumers stayed away. When I say consumers of jewelry, bars and coins, they stayed away. Investors in ETFs, they actually were driving the gold demand, right? Now, when gold price is actually range bound, and it also got softened a bit because of the interest rate movements and other aspects, what happened is investors are probably staying a little soft in their approach to gold, but consumers are coming back, consumers of jewelry. So that's the beauty of gold. And they also buy gold in jewelry form, but it is a form of investment. So right now, what we are seeing is, while the investment side is a little soft, you are seeing the consumer demand for jewelry, for bars and for coins and things like that actually rising faster. And while I don't have the figures for this September quarter, in our interactions, what we find is most of the jewelry trade is reporting very, very good activity, good engagement with the consumer. So you will probably see this, therefore, offsetting the softness in the investment side.
Right.
Because, yeah.
No, I get your point on this front. However, one thing that we've noticed about gold is that usually, as we've spoken, that in the last couple of years as well, gold has certainly grown as an asset. However, if you take the current year into consideration, gold is down by almost 9%. Now, you have real estate, which is up. You have equities, which has risen, and you have the dollar, which has risen. Now, what's surprising over here is that usually the dollar value generally moves in tandem with precious metals, wherein you have the dollar, which has grown by 3% already this year. So why this kind of differential that we are seeing right now?
Well, as you know, that the current policies, liquidity, they do tend to test some of the equations which we are used to in the past. You can't explain all that very clearly because the current policies, as you can say, is also something which has never been tested in the past. So in a sense, even the authorities are obviously using these policies, and part of it is experimentation. There is a lot of hope that we will be able to come back to normalcy, but it's not normal period. All right. So in this, if you really look at it, equity markets are going up, correct? I mean, everywhere. Equity markets are rising faster than the economic growth. So in a normal period, you would think this is hugely risky. But you're still seeing that, markets are going up and, testing new highs every day. You can't explain this so easily with what we have already known all these years. But clearly, we are saying that, look, risk is increasing and appetite for risk assets are increasing. It's an equation which we have not seen earlier. Having said that, that is where gold comes in, and that's where diversification plays a role, because the more riskier the environment becomes through investments in riskier assets, the more the need for gold. And gold right now is playing a very, as I said, it's range bound, it is static, there is nothing moving prices one way or the other. But that's where the beauty of gold lies in. You just keep it as an insurance, and you are taking other portfolio measures. And in a sense, it is therefore it's managing the risk in a way. So it's very difficult to explain why some of the equations with which we have all seen the financial markets work, why they are not working now. Why should gold price be this and the equity markets be this? It's a little difficult to say, because the policies are now a little aggressive. liquidity is driving more behavior than I would say clear risk-based assessment and investments.
Right. So is it right to say right now, Mr. Somasundaram, that gold as an asset class, it's pretty much undervalued as compared to the other financial asset categories?
Well, as I said, yes, instead of going into what should be the value of gold, we always, as the World Gold Council, we do give, as you know, we don't forecast what gold will be, but we do give tools. There is a tool called Quorum, which we have developed for those investors who are interested in knowing the intrinsic value of gold, what it should be, how it can play. You can go and plug in your own estimates of growth, interest rates, demand, and have a sight of what you think is the intrinsic value of gold, and you can play around with it. We also have measures ourselves, suggested measures. So this is available, but is gold undervalued? I think it is, as I said, it all depends on the portfolio that you have. If you're overweight on gold, it's one view you will take. If you are, if you have risk-based assets, then it's another view you will take. But overall, I will agree as a World Gold Council. I will agree. Yes, I think gold, as we stand today, it appears that it will play a far stronger role in portfolios, given the uncertainties we all face. It's not easy to say that these are all going to end in 12 months or 15 months. It's so uncertain. Therefore, that's where gold plays a bigger role. So I will leave it like that.
And my very last question coming to you is with regards to, as an investment opportunity, cryptocurrency is something which is picking up as well. Now, do you think, investors are probably even replacing gold with investments in cryptocurrency, and that's one of the reasons which is getting allocation to gold down as an investment bet?
Well, as I said, gold investment coming, Bitcoin affecting the price of gold is not a reality. It's not that people are removing from gold and going into Bitcoin. Some liquidity certainly is flowing into Bitcoin. Gold and investments in gold are actually a reflection of what happens to gold, the ETF, the price band, etc. It's nothing to do with what's happening in Bitcoin. In fact, Bitcoin is one of the risk assets that people are allocating some in part of the portfolio too. And the more you have investments in such risky assets, because when you put it in Bitcoin, your risk level always goes up. You need more gold to neutralize the risk, to balance the risk. So it's not, the equation is not gold versus Bitcoin. Gold is a very, very traditional asset class. It has got, centuries of behavioral data. Whereas when it comes to Bitcoin, it's very recent. It's been very volatile. It's, we have seen the risks there. So it's not like Bitcoin has grown at the expense of gold. No, that is not at all the situation.
Right. That's well put up as well. Thank you, Mr. Somasundaram, so much for joining us on the show. Always a pleasure to get great insights from you and to understand this entire investment asset class as a whole. Once again, thank you. Congratulations as well, and good luck with your campaigns that are going on right now, and stay safe, and speak to you soon again.
Thank you.
Thank you.